one of the big contributing factors for this market downturn is the slowdown that we're seeing in China. Recent data coming out of Beijing has pointed to a significant cooling in the Chinese economy. So the question is the Chinese economy sputtering? To answer these questions and more, we are now joined by Ben Simpfendorfer, who's Managing Director at Silk Road Associates. He joins us on the show from Hong Kong. Now, Ben, the recent signs of slowdown in the Chinese economy are beginning to rattle sentiment around the world. Do you think this slowdown is a temporary blip, or would you say there's a bigger story there?
Look, I expect the slowdown to be temporary. Certainly growth will remain above 8% this year. What we've seen is a correction in response to earlier policy tightening, but also weaker global demand. More important, though, the government has the policy firepower to support growth if it needs, either by releasing more credit into the system or simply through direct cash infusions. The bigger concern is 2012 to 2015, when the economy will run up against some significant structural obstacles to growth.
Ben, the governor of the People's Bank of China has hinted at possible interest rate cuts to fuel growth. But inflation continues to pose a problem. Do you see Beijing move on interest rates soon, and how big a cut should we expect?
We do expect at least one cut, perhaps two, but possibly not more than 50 basis points. Inflation problems remain serious. With the economy to accelerate again unexpectedly, inflation could tick up very quickly above that 5% level and move upwards towards 10%. The central bank is very well aware of that problem, and the concern, of course, is that inflation presents the greatest risk to the economy and would be the single largest driver of any hard landing. So the central bank has to be very cautious about how it responds to any perceived slowdown in either domestic economy or possibly even the global economy over the coming year.
So, Ben, what are the problem areas with the Chinese economy? Because so many reports suggest that China may fuel another crisis. Would you subscribe to that view?
There are a laundry list of problem areas, in particular the rise of the public versus the private sector. That trend was accentuated by the recent fiscal expansion. At the same time, there is a lack of credit for private enterprises who do want to upgrade, replace labor with capital, or perhaps move out of manufacturing into the services sector entirely. There's also the problems of an aging labor force, with the average Chinese 10 years older than the average Korean or Japanese at the same stage of development. And this is causing labor shortages and wage inflation. These are just three of, again, a laundry list of problems that the government needs to tackle. In particular, the incoming leadership. We need to see deeper and accelerated economic reform.
And what about Chinese commodity consumption, Ben? Because BHP Billiton has forecast a reduced demand from China. How do you see this impacting the commodity markets globally?
So far, commodity demand has, in fact, held up quite well, but no doubt concerns about slower growth, even at just 8%, will mean less or fewer commodity imports. Certainly, commodity markets will take this poorly. That said, if it's simultaneous to what is a perceived resolution of the crisis in Europe and the United States, not necessarily a view that we agree with, but nonetheless, if there's a perceived resolution, it may be that commodity prices will not fall as far as we expect. And the fact that we rule out a hard landing for China this year certainly argues in favor of that as well.